Hello everybody, happy Monday and welcome to the Tortoise channel. If you are new here, welcome. I do hope you make the most of it, and if you're not, thank you so much for the ongoing contribution. I keep repeating myself, but I cannot stress enough how grateful I am for all of you guys who've come here and actually left comments or smashed the like button. That really means the world to me, so thank you so much, and hopefully it will continue to happen so we can continue to spread the words and have people stop making silly mistakes, which are the same mistakes that I myself have made in the past. Okay, guys, so exact on the topic of comments, today I want to delve deeper into a company that you guys mentioned in the comments, right? So you've been asking me to mention a few companies, one of which was Adobe. And this is a company that not long ago was actually on my watch list. But in this video, I will explain to you exactly why I decided not to pull the trigger on this investment. And as always, I'm looking forward to your comments and feedback. Okay. So without further ado, let's hop right into it. And is Adobe a value trap? Is Adobe, does it provide a great value at current prices? Does it have a moat, right? Do we have skin in the game? These are the sort of questions that I always ask before making any investment decision. And as always, you know that I use stock analysis and stock unlock. Ideally, I would use just one provider because some of them, look, they show you different data. And for example, one of the things that I like about stock analysis is that they give you the inside score, something that doesn't happen with stock analysis. Okay, and for this reason, I try to juggle. Right, I try to juggle the two of them, but I find I find the two very valuable, which is why I like to have a look at these. I like to analyze companies while using both these stock analysis platforms. Okay, so let me just minimize this. And now let's try to determine whether Adobe has a competitive advantage, right? Now, what I want to do with, like in these videos, as you probably know, it takes time for me to do a full analysis on a particular company. And so what I can do right now is to just give you the financial side of things. I always answer like 13 questions before determining whether I should buy a company or not. And that includes questions like, is management competent? Do I think the balance sheet does it look pristine? Do I think competition is fierce? Okay. And of course, it's impossible to walk you through everything in this video, so I will just focus on the most important metrics, which are, of course, the ratios, the balance sheet, the income statement, and all of that. And so I do hope you manage to. I do hope you manage to understand my take on any particular company that I will be analyzing going forward. Okay, and so the goal here with Adobe, the main problem, in simple terms, is AI. Okay, before doing this, I actually worked as a software engineer, and I worked in the space for 6 years. And I worked with product owners, I worked with business analysts, and so on and forth. And I know people, especially people that are in the product space, that have intentionally stopped using Adobe. And the reason for that is because competition is coming up and they are cheaper and, according to what they say, better alternatives to this company. Now, look, guys, I've never really used many of Adobe's products, okay, so I can't really say for sure whether that is the case. But what I do know is that these people work with these tools on a daily basis. Okay, so for them to be switching to other providers, it means exactly that. It means that Adobe is no longer as strong, right? It's no longer as unique as it used to be, and so take that into account. On top of that, the main reason we are seeing like this sell-off in the company, right, and some detachment from fundamentals is exactly because on top of cheaper and more accessible alternatives to Adobe's complex professional-grade software, right, appealing to a broader user base, we also have the advent of artificial intelligence. Okay, and because Adobe is a software company, we don't know how disruptive AI is going to be. According to what the companies say, AI is going to be complementary, right? It's not going to be disruptive, but of course they are biased. I wasn't expecting them to say something different, but you need to understand exactly how AI can be disruptive. This would require me, because I don't know the answer to this question, okay, and I see AI disrupting many businesses across industries. This is precisely why I decided not to invest in Adobe. Okay, and in fact, if we go here to our stock unlock page, you can see that the inside score is about 4.48 out of 5, which is stellar. And you will see as we go, as we move on, move along the video, you will see that Adobe meets practically all the criteria that we are looking for in a great company. Okay, namely, for example, look at this: profitability is ridiculously high, management very good, growth, financial health. I mean, across the metrics, across all metrics, you can see that Adobe really checks the boxes. Even analysts, despite the stock despite the stock being down, analysts remain constructive, and so does valuation. And so let's talk about then the fundamentals of the business, starting with our income statement. And if we go to the income statement, you can see. Let's flip this to the trailing 12 months. Here, okay, and now let's have a look at revenue. I mean, you can see that revenues have increased substantially, right? In fact, if I go here, it's even easier if I do it like this. We are now on the yearly. Look what happened to revenue. You can see that since 2019, revenue has compounded by about 14%. Now, we want revenue to grow at least at 10%, okay? That would be awesome, and that is certainly the case with Adobe. So, okay, nothing wrong with revenue here. In fact, if I flip this to the quarterly, to the quarterly button, to the quarterly screen, you can see that on a quarterly basis, revenue actually continues to go up. Okay, this only goes back to 2019. Look what happened if I go to 2015. Revenue has compounded by about 17%. And look, I mean, it's incredible, right? So it's not like the business has been slowing down sharply from a revenue standpoint. That is not the case. So that's one thing that I like to see. Also, take a look at net income. Look at that. Going back to 2014, 35% compounded. And if I zoom in on this, since 2019, you can see that revenue has compounded by about 13.49%. If I flip this to the quarterly frame, look at that. Yes, revenue declined a bit here from from the second quarter of 2025, but now it seems that we are up again, and so nothing to worry about. In fact, this is one of the highest earnings the company has ever reported in its history, going back to 2019. All right, so all of this is something very good. And on top of that, look at the diluted shares outstanding. The company has been buying back shares aggressively, yeah, which is something that we like to see. And I assume they have the free cash flow available to do exactly that when the price is trading at, I think, its cheapest valuation in history. And you can see, I mean, look at this. So since 2022, the share count has been reduced by 10%. Okay, that's very good. It means that the company is committed to buying back shares, which increases our ownership in the company. Okay, without us putting more money to it. So I like that a lot. Okay, Adjusted EPS also going up, very, very good. Then we have some of the operating expenses. Yeah, okay, so look at that. One of the things that I really like is that while revenue compounded by about 60% since compounded by about 17% since 2016, you can see that net income has actually grown by about 21.53%. Okay, this company is very profitable, and so they have managed to increase earnings at a faster rate than revenue. You cannot do that without having great margins, without having margin expansion over time. And if I go here to the metrics, look what happened to gross margin. Okay, look at that. Amazing. 87% is the average. Right now we are at 89%. So margins are at the highest level they've been. Okay, that's very good. So I mean, just looking at this, and of course this goes to show how profitable the company really is. But if the moat has been breached, you would see like pressure on margin, on gross margin, but I'm not seeing that right now. What this actually tells me is that margins have been expanding since 2022. And this is very good. Okay, maybe they have pricing power? That's precisely why. Probably look at the operating margin. Okay, so the average is about 32 right now. We are at 36%. Again, margin has been expanding. Okay, and 32% average over going back to 2016 is absolutely insane. All right, let's have a look at net margin. This is where we are seeing some pressure, as you can see. It was at 40% in 2020, but this was probably because of COVID. After that, we saw some normalization. But then you can see that this has been declining since 2020. So in 2020, I will regard it as an outlier. So we'll just look at 2021. And the matter of fact is that it's been under pressure. So if you are in the space, again, you have to understand why net income, why profitability has been under pressure. Is the company investing a lot into growth? In which case that profitability is going to be hurt, right? We have to understand these things. What about free cash flow margin? It's actually, it went down in 2023, and now it's at 36, about 37%. But I expect Adobe to be reinvesting, right? Exactly to maintain its competitive edge. And if I go here to cash flow, and if we go to capex, let's see, capex here, investments in property, plant, and equipment. Look at this. So the company has invested quite a lot since 2018. Look at that. More intensely in 2022, as you can see right here. But right now, let's flip this to the quarterly. Yeah, so not really. In fact, they have decreased the amount they have been spending since 2022. So it's not like they are using more and more free cash flow just to invest in future growth. Okay, let me have a look at depreciation and amortization. I don't. Yeah, this is just because Adobe is a capital light company, so this is not something very, very important. But typically, I would use this as a proxy for maintenance capex. Okay, but this is a very capital light company, so yeah, I mean it's just what it is. And now, so look at the cash from operating activities growing at about 17%. Again, phenomenal growth, very profitable. Let's have a look at the stock-based compensation. I don't like to see this. Okay, I don't like that. And in fact, if I go, stock-based compensation has increased, but what about as a percentage of revenue? And that's the problem with these tech names. They just do a lot of share-based compensation, and I just don't like that. But I believe this is probably being offset by share buybacks. So take that into account. But you can see that the share-based compensation as a percentage of free cash flow, is at one of the highest levels. All right, it's at right now is about 23%. Share-based compensation as a percentage of revenue is as a percentage of operating cash flow at 23%. So look, share-based compensation is a cost to shareholders and should be treated the same. And so when calculating the valuation for Adobe, right, based on future cash flows, make sure that you exclude the share-based compensation, as you can see right here, right? In fact, if you go here to look, free cash flow excluding share-based compensation, free cash flow with share-based compensation is, let's see, if I flip this to trailing 12 months, is about 9.5 billion. Without share-based compensation, that's about 7.5 billion, give or take. Okay, so use this metric because you, as a shareholder, because the company does a lot of stock-based compensation, you just should exclude that. Okay, to give a more realistic picture of the real cash flows. Okay, good. So this is going up, and by the way, free cash flows have been going up by about 19.67%, even if with share-based compensation excluded. Right? Look at that, 19.3%. This is very, very good. Okay, very, very good. And if I show you now, let's have a look at the balance sheet. Look at assets. Assets have been growing nicely. I don't expect anything different. Okay, so this is, I want to see cash and cash equivalents. And if I do that, you can see that they have been growing. So right now we are sitting on, let's see, we have total cash about 7.886 billion. And you can see that liabilities, total liabilities, we have about 16 billion in non-current liabilities. Let's have a look at the book value. Book value has been increasing until 2023. Now it's down. Okay, is the company taking a lot more debt? Yeah, this is something that we need to consider. Okay, and let's have a look at this. See if I can have a look at what happened. So cash and short-term investments, we have about 6 billion, as you can see right here, in the total current assets. So it's not that we don't have a net cash position. If I go to statistics and if I show you the balance sheet here, look at the net cash per share, right? So the net cash is actually negative, about 1 billion. And this is something that we have to understand. I have to understand why that is. And going here to the balance sheet, so I can see, for example, that total liabilities, okay, were increased. But what about the long-term debt? This is where exactly. Look at this. Long-term debt has increased substantially from 4 billion, in fact, from 3 billion, 3.5 billion in 22 to almost 6.20 billion today. So that long-term debt has more than doubled from 2022. Okay, you have to understand why is the company taking on more debt. Is it because they need to maintain their competitive position, right? Because this is a company that still generates a lot of free cash flow, and so they are not in any kind of financial difficulties. It's a very profitable company, as I just said. But again, you have to understand why that is. Okay, and likewise, this will explain why the shareholder equity has been trading lower since 2023. Okay, let me have a look at the retained earnings. If I look at the retained earnings, let me have a look here. What am I doing? Retained earnings right here. Okay, they continue to go up. This is very good. Okay, this will essentially is how much profits the company retains that haven't been paid out as dividends. And so you can see that, yeah, it's a very profitable company that still creates a lot of shareholder value. Um, uh, and so, look, from a financial standpoint, I mean, I like what I see. Let's have a look at some of the statistics here. Yeah, look at that. So we already discussed the income statement, the balance sheet, the cash flow statement. Okay, look at margins. Margins are absolutely astonishing. Okay, very profitable company. Yeah, look at the returns. Yeah, this is very, very important, and you can see that the return on equity sits at 52%. Yeah, return on invested capital sits at 27%. Ideally, we like to see this above 15 or at 15. So, I mean, this is a company that generates a lot, that has a great history of deploying capital very efficiently. Okay. And if I show you that here, if I go here to the metrics, yeah, let's have a look at return on capital employed. Look at that. It's actually expanding. Yeah. Look at the return on capital employed. Has been expanding since 2000, sharply since 2023. Okay, but this can be, so this is capital employed. Let's have a look at the return on equity. It's also going up, but remember that the company has taken on more debt. Yeah, but still, it goes to show that that this metric is also going up. And look at the return on invested capital, by far the most important metric, if you ask me. Also trending upwards. So what this tells me is that the company has become more efficient. Yeah, which is very, very good. And the CEO has been at the helm for many, many years, so he knows the company inside out, which is very important as well. Look at that. Awesome. Great to see that the ROIC is just going up along with other efficiency, capital efficiency metrics. Okay. So, and we, in terms of debt to free cash flow, only at 0.69. So the company has a very good balance sheet. To be even better, it would have to be, it would have to have a net cash position. But still, this is a company that could pay all of its debt within less than 1 year of current free cash flow. So nothing wrong with that. And from a valuation standpoint, if you look at the price to free cash flow ratio, for example, going back, let's have a look at the valuation on a relative basis. So let's flip this to the trailing 12 months again and look at the price to free cash flow. Look at that. Okay, at its lowest valuation at its lowest level is going back to 2016. To zoom out the noise, look at that. If you exclude 2022, then this is certainly one of the lowest. What's this? Price to free cash flow. Yeah, but this is the yearly. We have to change this to the trailing 12-month figure. And look at that. Very, very cheap, right? Look at the price to operating cash flow. Very, very cheap. Look at the price to earnings. Very, very cheap. So on a relative basis, this company is at its lowest valuation in history, going back to 2016. I like to see that. So the question now is, do I think the company, what's currently being priced into the stock? And for that, I would have to go here to my intrinsic valuation model. And I think I have Adobe here. Let me just bear with me 1 second, because I don't think this is where I keep my watch list as well. So all these companies that you can find here, right, in these tabs, they are part of my watch list, some of which I've already invested in, of course. Do I still have Adobe here? Adobe, it's right here, but disregard these metrics because they haven't been updated since March 2025. But what I want to show you is the intrinsic value of the company. And let's just run a DCF model, and let's use the free cash flow excluding share-based compensation as I mentioned. Okay, and if I do that, let's go here, cash flows, trailing 12 months, free cash flows excluding. So we have 7705. That's 77705. And now for the growth rate, let's quickly have a look at what analysts are projecting for the company going forward, for earnings specifically. And you can see that they are very constructive. So they are assuming 18.45% like earnings growth, earnings per share growth over the next 5 years. Because I want to be conservative, I'm just going to use 15%. And now let's have a look at cash equivalents. Cash and cash equivalents. And you can see that's about 5,940. 5,940. Okay. Let's also check total debt. So do I have total debt right here? Total debt. I have current debt. Well, I mean, I have that metric right here, so it's just easier for me to come here, trailing 12 months, balance sheet, and you can see total. Yeah, so total debt should be right here. Total debt 6655. That's 6655. And then you have shares outstanding. Let's see what we have. Shares outstanding, and we have 434. 434. Okay. And if we do that, assuming we want a 15% return on our money every year, which means we will have about two doubles over a 10-year time frame. And so the DCF price per share, yeah, is about 284. Okay, 284. And the stock is currently trading at 324, which means that by these standards, by my standards, the company is still a bit expensive, yeah, on a DCF basis. Because remember, I excluded share-based compensation from the free cash flow. So this is adjusted free cash flow, and you should do that because again, stock-based compensation is a cost for shareholders and should be treated the same way. And so if I had put here 9 billion, then of course the DCF, the company would look cheap. But by all means, you should exclude that, not least because they are actually growing that share-based compensation, which is something that I don't really like. But when you do that, remember, I always want to compound. I always want a double, like at least every. I always use 15% as my discount rate. And this already has significant margin of safety applied to it in case things go wrong. So I would have to wait until 284. Now, if you want to see the kind of growth rate that is currently built into the stock price, you would have to adjust the growth rate. So if I change this to 18%, look what happened to the DCF price. It goes up to 340. And the stock is currently at 324. So we have to lower this a bit. Let's change it to 17. Bingo, we have about 320. So the market is pricing Adobe as if the company is going to grow its adjusted free cash flows by 17% per year over the next 10 years. So the question you have to ask yourself is, do I think this is fair? Do I think the company will deliver this kind of growth? And this is where you should look at history and check what kind of growth the company experienced in the last 10 years. And if I go here to Adobe once again, and if I look at their adjusted free cash flows, we go. Let's change this to yearly. Look what happened to adjusted free cash flow. So going back to 2016, the company has compounded adjusted free cash flow at 17.65%. So for the company to repeat that over the next decade, I mean, it can happen, right? But consider the fact that competition is fierce. Consider the fact that AI may be disruptive, and so if you think this is still the case, this is likely to happen, then you could purchase already Adobe today, okay? And that's it. I personally think analysts are typically bullish, right? So, and based on history, I like to stick with 15%. I never use growth rates above 15%, okay? In which case I would have to wait a bit longer. But I mean, will this come down to 284? I mean, I don't know. And even if it did, as you already know, I wouldn't be buying it exactly for the reasons that I mentioned. Adobe is a software company, and software companies across the board, yeah, are being hit because of or exactly of AI, and we don't know how disruptive this is going to be. I don't want that uncertainty in my portfolio. I run a concentrated portfolio of companies I have a high conviction in, and I don't like the risks around Adobe. Okay, they really cast a lot of doubt on the future outlook of the company. So for me, Adobe is a hard pass for now. Okay, so guys, I hope this has been insightful. If it was, please, I'm looking forward to reading your feedback. Do you think Adobe is a great company? Is it subject to disruption? Let me know in the comments below. And if you like the video, smash the like button. It helps us a lot. The goal is for us to continue to put out as much value as possible. So thank you so much for all the contribution. Yes, stay tuned for upcoming videos.